Hello and welcome to Digital Accounting Education, a channel that strives to make accounting and EMS easy for you to understand. Please don't forget to subscribe and comment down below what other topics you would like to see from me next. Also, please don't hesitate to contact us on WhatsApp so we can help you prepare for your examinations. So let us get into today's lesson. In today's lesson, we are going to do an accounting equation. So the information says the transactions below appeared in the books of Waterkloof Traders for the month of March 2023. Waterkloof Traders uses 80% markup on cost price. So when you are reading the information, please make sure that you underline or you highlight the important parts. In this case, the important part is the markup because we are going to use this markup. So this business uses 80% markup on cost. Okay. So now it says you are required to use the information of Waterkloof Traders to show the effect of each transaction on the accounting equation for March 2023. So now this is the accounting equation that we are going to do. So the accounting equation we are going to do, or that is required from us, is this one. So it has a section of general ledger, as you can see. So this is the general ledger. You're going to show the account debited and the account credited, and then you have your normal accounting equation where you show the effect in the assets, in the owner's equity, and in the liabilities. So the first transaction, which happened on the 1st of March 2023, says bought goods on credit from AB Traders for 10,800 less 10% trade discount. So with each and every transaction, make sure that you understand exactly what happened, okay, before you even try to answer it. So in this case, it says we bought goods. We, I mean the business, okay? It's easy to refer to the business as us. So you put yourself in the shoes of the business. So we bought goods on credit, okay? So we didn't pay for these goods. We bought them on credit from AB Traders, and the goods cost us 10,800. However, we received a trade discount, a discount of 10%. Okay, so now since we bought goods on credit and we received discount, it means we have to calculate the amount that we owe to AB Traders since we do not owe them the full 10,800. So what I need you to know is that when you are paying full price on anything, you are paying 100% of that amount because there's nothing that has been subtracted from it. Okay. However, if you receive a discount, it means you're no longer paying 100%. You are going to pay less than 100%. So in this case, AB Traders gave us 10% discount. Okay. So it means we are now going to pay 100% minus 10%, which means we are going to pay only 90% of the amount. Okay. I hope you got it. So we bought goods for 10,800, which is the 100% amount, but we are not going to pay the 100% since we received 10% discount. We are only paying 90%. So how much is the 90% of this amount? You're going to say 10,800 multiplied by 90% or 90 over 100, and you will get the amount that Waterkloof Traders owe to AB Traders. So you're going to say 10,800 in your calculator multiplied by 90%, which is 9,720. So it means we are only going to pay 9,720 to these people. Okay, so now we have the amount we actually owe to AB Traders. Let us go into our accounting equation and record this transaction. This happened on the 1st, right? So you have to write the date to show that this is for the transaction that happened on the 1st of March. And then we go into our general ledger. Remember, a general ledger is a T account. Okay, so now account to be debited. Before we even get to the account to be debited and account to be credited, let us identify the accounts that are affected. So now since we bought on credit, when we buy on credit, it means our creditors are affected because the people we are buying from on credit are called our creditors. And our creditors in accounting, we call this account creditors control. Okay, another account which is affected is trading stock because we bought trading stock or we bought goods. Okay, so these are the two accounts that are affected when we buy goods on credit. Okay, so with the T account, this is how it's going to look. Okay, trading stock, we know that it is an asset, and assets, they increase on the debit side while decreasing on the credit side. Creditors control is a liability account which increases on the credit side and it decreases on the debit side. So now, to know which account do we have to debit or account we have to credit, we need to ask ourselves, is our creditors control account increasing or decreasing? Since we bought on credit, it means our credit, or our liabilities are increasing, meaning now our creditors control will have to be credited since it is increasing. Okay, and then when it comes to trading stock, what is happening to our trading stock is we bought trading stock, meaning the trading stock account, or the value of trading stock that we have in the business right now, it is increasing since we bought more stock, meaning our trading stock account will be debited. Okay, so now we know our trading stock account is debited while our creditors control account is credited. Please let me know if you want a detailed lesson on the T accounts. So we go to our accounting equation, our general ledger, and we say account to be debited is trading stock. And then account to be credited is creditors control. So now we get to the accounting equation part. So we have to show the effect with the amounts. Okay, our trading stock, we already said that it is an asset account, right? So what is happening to our assets? We said our assets are increasing. We said our assets are increasing here because we are buying more stock. Okay, so it means in our assets, it is going to be a plus 9,720 because that is the amount that we owe. And then our creditors control account, we said it's a liability account, which means our debts, or the debts of the business, are increasing by 9,720 as well. Now we move on to the next transaction, which happened on the 7th. Okay, so on the 7th, paid 450. So I said it's easy if you say we paid. Okay, so we paid 450 out of the petty cash to Parcels Aras. So this is the name of the business, to Parcels Aras, for goods delivered to a debtor, J. Donovan. The amount must be debited to his account. So now I explained that you need to understand exactly what it is that they are telling you. So they are saying we paid 450,000, right? However, this 450 rents that we paid, we didn't pay it out of our bank account. We paid it out of our petty cash box. Okay, and we paid this amount to Parcels Aras for goods delivered to a debtor. So in this case, they are saying we paid that amount to Parcels Aras to deliver goods to a debtor on our behalf. Okay, and then that amount that we paid on behalf of the debtor, it must be debited to his account, meaning that he owes us this amount. So how do we show this transaction? So what we know is that we paid 450,000, right, out of our petty cash account. So petty cash will obviously be the first account that is affected, right? And then another account which is affected will be a debtors control account, because those goods are going to one of our debtor. So the second account will be debtors control. So whenever we sell something on credit, debtors control account will be affected. However, when we buy something on credit, our creditors control will be affected because we are buying from our creditors. So now, petty cash. What type of account is petty cash? Petty cash is an asset account. Okay, we know that assets increase on the debit side, they decrease on the credit side. Then when it comes to debtors control account is also an asset account, which means it also increases on the debit side and decreases on the credit side. So now we have to figure out which account is decreasing and which one is increasing. So in this case, they said we paid 450 out of our petty cash, meaning that our petty cash will decrease since we are taking out money out of it to make a payment on behalf of our debtor. So it means it is going to decrease by 450. So it is the account that will be credited. Debtors control. What is happening to our debtors control? So our debtors control is increasing. Why? Because we sold on credit, or the amount that our debtors are owing us is increasing since J. Donovan now owes us 450 more. So our debtors control will be debited since our debtors are increasing. So which means debtors control account is the account which will be debited. So this happened on day 7. Okay, so on day 7, account that is debited, we said it is going to be debtors control because our debtors are increasing, or the value owed to us by the debtors is increasing. And then the account which will be credited is petty cash because our petty cash is decreasing since we are paying money out of that account. So we said both of these accounts are assets, which means now the effect will be shown only in assets. We don't have an owner's equity account that is affected, and we also don't have a liability account that is affected. You can write a dash or a 0. So with debtors control account, we said that it is increasing, right? Which means it is going to be a plus 450 into our debtors control account, and then minus 450 from our petty cash. And both these amounts are shown in the assets because both these accounts are assets. Okay, moving on to the 16th of March 2023. So on the 16th, we sold goods on credit to KMOS for 4,500 and we issued an invoice. Since we sold goods on credit to KMOS, it means KMOS is our debtor because debtors are customers who buy from the business on credit. So KMOS bought from us on credit, meaning that KMOS is our debtor. Okay, so let us show the entry. So two accounts which are affected will be debtors control. Why? Because we sold on credit. We sold to one of our debtors, meaning the amount or the value of debtors in our business is increasing. And we said already that debtors control is an asset account, which means it increases on the debit side and will decrease on the credit side. And then another account which is affected will be trading stock. Why? Because we sold goods. Okay, we sold goods, that's why trading stock is affected. Trading stock, we also said that it is an asset account, which means it increases on the debit side and decreases on the credit side. So now, what I want you to know with this type of transaction, whenever we sell, whenever they say we sold goods, okay, if we are selling goods, you need to calculate you need to have both the cost price and the selling price. Okay, it is imperative for you to have both the amounts. Okay, which means now there will be 4 accounts that will be affected. So since we have 2 accounts already that are affected, which I said it's trading stock because we are selling stock, and then debtors control since we sold on credit. Okay, so 2 other accounts which will be affected will be sale account as well as cost of sale, since you need to have both the amounts. So with a sale account is an income account, and all our incomes will increase on the credit side and decrease on the debit side. So it's an income account, while our cost of sale is actually an expense account. And expenses accounts always increase on the debit side and they decrease on the credit side. Okay, I know this is a bit confusing, but please stay with me. So this is what is going to happen. Our debtors control account, remember this is the amount that is owed to us by the debtor, right? So the debtors control account will be affected by the sale amount because that is the amount which we sold the goods for. Okay, and then trading stock account will be affected by cost of sale because when we record in the trading stock account, we record at cost price. I hope you understand. So let us just do it so that you can understand. Let us first start with the debtors control account. So the debtors control account, I said, will be affected by the sale amount, right? So how much did we sell for? We sold the goods for 4,500. Okay, so now let us go into our general ledger and record this. Okay, so we said the transaction was for the 16th. So account that will be debited. Okay, so account that will be debited between these two will be a debtors control account. Why? Because our debtors are increasing. Okay, and then the sale amount or the sale account, sorry, will be credited because why? We made a sale, meaning our sales have increased. So in our general ledger, the account to be debited will be debtors control, and account to be credited will be a sale account. So debtors control, we said it's an asset account, meaning our assets or our debtors are increasing by 4,500. And then a sale account is an owner's equity account, or it affects owner's equity. So we said our sale is credited, and on the credit side, that's where it is increasing, right? So our sales are increasing since we made a sale, so it is going to increase. Our owner's equity is going to increase by 4,500. So our liabilities, there won't be any effect. Moving on to our two other accounts, which are trading stock and cost of sale. And I said that trading stock will be affected by the cost of sale amount. How do we get a cost of sale amount? Because if we go to our transactions, they said sold goods on credit to Kmos for 4,500 and issued an invoice. How do we know the cost of sale amount? This is where the markup comes in. That markup percentage that you have highlighted, this is where it comes in. And you need to know how to calculate the cost price when the markup is given. So the formula that I taught in one of the video, which is appearing now on your top right and will be linked down below, this is how we calculate our cost price or cost of sale. So we are going to say cost of sale, since it is the amount we are trying to find, equals to 4,500 multiplied by 100 divided by 180. Please check out that video where I am explaining how to calculate the cost price. It is so helpful because you always have to use markup. So 4,500 multiplied by 100 divided by 180, 2,500. So our cost of sale will be 2,500. Okay, so now this is the cost of the goods that we have sold at 450. We go into our general ledger, and we said two accounts that are affected by cost price are trading stock as well as cost of sale. Account to be debited will be cost of sale. Account to be credited will be trading stock, because trading stock is decreasing and all our assets decrease on the credit side. Okay, and then cost of sale is an owner's equity account, and all expenses decrease owner's equity, so it is going to decrease it by 2,500 because we said it is affected by the cost price. And then trading stock account is actually an asset account. So what is happening to our trading stock? It is decreasing since we sold goods, okay, or we sold trading stock, so it is going to be minus 2,500. Please, if you have any questions, drop them down below. My notifications are always on. I will respond to you ASAP. Moving on to the 19th. On the 19th, a printer bought on credit. So now we bought a printer on credit for office use for 2,400 from XY Printing in February 2023. Okay, so the printer had a defect, meaning it was faulty. After consultation with XY Printing, the printer was returned to them. No transaction was recorded. So I said you must please understand what happened here. So what happened? Remember, we are doing transactions for March, okay? So what they are telling us is that back in February, we bought a printer from XY Printing, and the printer was faulty, and this printer, we had bought it on credit. So we agreed with XY Printing that we are returning it to them, and we actually did. So this transaction was not recorded. We need to record this transaction. So how do we record it? We first start by identifying the accounts that are affected. Okay, so since we bought this printer on credit, guess what account is affected? You guessed it right, creditors control. Okay, so we agreed that one of the accounts that is affected is creditors control. And why is our creditors control affected? Because we bought on credit, okay, from our creditors. So our creditors control account, we said it's a liability account, and all liabilities increase on the credit side and they decrease on the debit side. Another account which is affected will be equipment. Why is equipment affected? Because we had bought a printer, okay, and a printer is an equipment. Is another account which is affected. So equipment is actually an asset account. Asset accounts increase on the debit side and they decrease on the credit side. So now what happened? We had bought a printer, right? However, we returned it, meaning now the printer that we had bought in February, it had increased the value of our equipment in the business, but now we returned it, which means our equipment value will now decrease since we took it back, which means our equipment account will be credited since we are minusing the printer from the value of our equipment in the business. Creditors control, when we bought on credit, we obviously increased our creditors control account since our debt has increased. But now the opposite happened. We returned the printer, meaning now we are no longer owing anyone that 2.4, which means we must decrease it from all the debts of the business. So our creditors control account will now be debited. So we go into the general ledger to show which account was debited and which one was credited. So on the 19th, account to be debited is creditors control, because we have to minus the amount that we had said we owe to the XY printing. Account to be credited is equipment, because the value of the equipment that we have in the business is decreasing. We are actually showing that our equipment is decreasing. The equipment that we have in the business is decreasing. So now we move on to the accounting equation to show the effect. Equipment is an asset account, and what is happening to our asset account? It is decreasing by 2,400, and creditors control is a liability account, and our debts, which are our liability accounts, are actually decreasing by 2,400. We don't owe it anymore. So we move on to the 21st of March, and it says a credit note of 1,200 was issued to KMOS for returns of some of the goods bought on the 16th of March 2023. The goods were not returned to the storeroom as they were totally damaged. So again, understand what is happening. Whenever we issue a credit note, know that the goods have been returned. So now KMOS returned some of the goods that he or she bought on the 16th. Remember, on the 16th, KMOS bought goods from us, right? And he or she had bought goods for 4,500, but this time, this person returned goods worth 1,200, okay? So they didn't return all the goods. However, these goods were not returned to the storeroom as they were totally damaged. So how do we record this? Two accounts that are affected first. The first one obviously is the goods, which is the trading stock account. Okay. Second one, it will be debtors control account, because this person that we are dealing with is our debtor, and these are the goods that he or she had bought on credit. So this is how we are going to do it. We said the first account which is affected is trading stock account. Okay, trading stock account, we said it's an asset. By now you know it off by heart, and assets increase on the debit side, they decrease on the credit side. Okay, and then the second account which is affected will be debtors control, because we are dealing with a debtor. Debtors control is also an asset account, increases on the debit side and decreases on the credit side. So what happened here is that a debtor returned goods. Okay, usually when they come to buy, we increase their account. Why? Because the value of our debtors in the business is increasing. But when they return or when they pay, we have to minus the debtors control account, because the value of our debtors is now decreasing. So KMOS brought back the goods, meaning we have to say now this amount, we are no longer expecting it from one of our debtors because they returned the goods, which means our debtors control account will be credited to show that there is a decrease in the amount owed to us by the debtors. So now with trading stock, they said that the goods were not returned to the storeroom as they were totally damaged. Okay, so if the goods had not been damaged, we were going to add them back into the trading stock account, but this time around we can't do that because they were damaged. Okay, so we can't say the goods have been recorded into the trading stock account. Okay, so now the account that will be affected will be debtor's allowance. Why? Because every time a debtor brings back goods that are damaged, or just because they want to bring back something they are not happy about, or because they changed their mind, a debtor's allowance account will be affected. So now our debtor's allowance will be an expense account, okay, which means now it increases on the debit side and decreases on the credit side. This is on the 21st. So debtor's allowance will be debited. Our debtor's control will be credited since it is decreasing. So debtor's control account, we said it's an asset account. So now this debtors, or this debtor, does not owe us this amount anymore, so we have to show that there is a decrease in our debtors. And then debtors allowance account will affect our owner's equity, so it's going to be minus 1,200. So day 25, we received 3,400 from our bond, a debtor, in settlement of her account 3,500. So here you can see that there's two amounts. It says we received 3,400 and this person is settling her account. And if someone is settling her account, it means they are paying it in full. So it says in settlement of her account of 3,500, sorry. So if they are saying we received 3,400 and this person is settling the account of 3,500, what do you think happened? Where is the other 100 rands? We gave our bond a discount. Okay, so now if this person settled their account with less money than they actually owe us, and we are saying they are settling their account, it means they have received a discount from us. In this case, they have received a discount of 100 rands because we can tell that the difference between these two amounts is 100 rands. Okay, so it means now there's a lot of accounts which will be affected. So in this case, 4 accounts. So the first 2 accounts which will be affected will be bank. Why bank? Because it said we received 3,400, and when we receive money for whatever reason, our bank will always be affected. So bank is an asset account, increases on the debit side and decreases on the credit side. Okay, another account which will be affected will be debtor's control account. Why? Because this person was our debtor or is our debtor. Debtor's control account is an asset account as well, increases on the debit side and decreases on the credit side. Okay, so now with our bank, what is happening to it is that it will increase. Why? Because we have received money into the bank. So we received 3,400, okay, which means now our debtor's control will decrease since this person is paying. Our debtor's control will decrease by 3,400. So now how do we account for this 100 rands discount that we gave to the debtor? We need to account for it. We can't just leave it. We have to show that. Okay, so now another account which will be affected in this case, whenever we give out a discount, the account which will be affected is called discount allowed. And discount allowed is an expense, which means our expenses increase on the debit side and they decrease on the credit side. So now if we allowed an interest, so if now we allowed a discount of 100 rands, it means now our discount that we have given to the customers will increase by 100. Okay, so discount allowed will be debited and the contra account for that will still be debtor's control. Remember, when this person paid or when this person bought from us on credit, we had increased their account by 3,500 because that is how much they owe us, right? Which means when they come to pay but we give them a discount, we have to show the discount that we have allowed them also in the debtors control account. So now we are showing that their debtors control has increased also by 100 rands, but this 100 rands is for the discount. So in total, you can see that we are saying our debtors have decreased by 3,500, which means that is the initial amount that was owed to us. If you need any clarity, drop the questions down below. I'm available to answer the questions. This is day 25. First account which will be debited will be bank, because bank is increasing. Second account to be credited will be debtors control. Remember, debtors control is affected twice, but you don't have to write it twice. Okay, so bank is increasing by 3,400 and debtors control account is decreasing by 3,400. Okay, so now for the discount that we have to account for, the account that is affected is discount allowed, and we said a discount allowed will be debited. So that is the other account which is affected. Discount allowed. Okay, so discount allowed, we said it is an expense account and all expenses decrease owner's equity. Okay, and then we also have to show that our debtors control account also decreased by 100 rands. Okay, if you have space, you can just write it underneath. Last transaction on the 31st of March 2023, a loan repayment of 44,000 to Investec Bank included an interest of 10% per annum for 1 year. Funds were paid via EFT. Okay, let us try to understand what happened. So they are saying a loan repayment of 44,000 to Investec Bank. So it means we paid a total of 44,000 to Investec Bank, and this amount included, meaning in this amount there is an interest of 10%, okay, per annum, and funds were paid via EFT. EFT means we just paid from our bank. Okay, so already you know that bank will be one of the accounts that will be affected. Bank is an asset, increases on the debit side, decreases on the credit side. And then another account which will be affected will be loan. We know loan is an account, and it is actually a liability account, okay, because it's a debt of the business. So it's a liability account. That's an L. So loan account will increase on the credit side and decrease on the debit side because it's a liability account. All liabilities increase on the credit side and decrease on the debit side. Another account to be affected will be interest on loan, because the amount includes interest on loan. Okay, so interest on loan. Interest on loan is actually an expense account. Why? Because it is the cost of borrowing from the bank. Okay, so expenses always increase on the debit side and they decrease on the credit side. They are just like assets. So now we have 3 accounts that are affected. How are we going to get the loan amount? How are we going to get the interest on loan amount? Because we only have one amount. The good thing is that they gave us the percentage of the interest. Okay, so now they said we paid 44,000 to Investec, and in the 44,000, 10% is for interest. Okay, so this is how we are going to calculate it. So we paid 44,000, and then 10% of that is for interest. Okay, let's go to our calculator. 44,000 multiplied by 10%, 4,400 is the interest amount, because it is the 10% of 44,000. Okay, so now how do we get the loan amount? So since this interest of 4,400, we know the amount already, so it means now we're going to say 44,000 minus 4,400 of interest. Whatever amount that is left will be for the loan repayment. Okay, so this is the loan amount. Okay, in our general ledger, what is actually happening? Let's look at our bank. our bank is actually decreasing. Why? Because we are paying 44,000. Are we together? And then our loan, since we are paying our loan, it is going to decrease. It is not going to decrease by 44,000 because the loan amount is not 44,000. We just calculated the loan amount, which is this one, right? We said it's a loan amount that we're actually paying, right? So it is 39,600. So our loan is decreasing by 39,600. Our interest on loan will be the remaining amount, which we also calculated here, the 10% of the amount that we actually paid. So this will be 4,400. So now when you are looking at this T account that is debited, or accounts that are debited, will be loan as well as interest on loan. So this was on the 31st. So our loan account was debited, okay? And our loan account, we said it's a liability account, which means our liabilities, which are debts of the business, they are decreasing by 39,600. And then another account which is debited is interest on loan. Okay, interest on loan is an expense account, and I said expense account minus or decrease owner's equity account. And then another account which was affected was bank, and bank this time around is credited because it is decreasing since we are making a payment. Okay, so our bank account will decrease by the total of 44,000. We have come to the end of this lesson, and don't forget to subscribe and share the video. Also text the number down below if you would like some extra help.